Hello, friends. Welcome again to the monthly edition of Cedrus Bytes, whereby we give a differential perspective uh, into the various investment options which are available. And today, I would like to throw some light upon the underperformance of equity mutual funds and whether investors should write off these funds just because they have been underperforming since quite a while now. Since the past 3 months, if you see the various reports, you have seen outflows from equity mutual funds, be it outflow from large cap funds, multi cap funds, even SIPs, where investors invested for a long term perspective to and had inculcated a savings habit because of regular investments into these funds, they have been discontinued. Uh, the first thing is, why should an investor be in a fund which has been underperforming since such a long time? It's been more than 2 years where they have underperformed the benchmarks. When we invested in a mutual fund, typically an advisor will always tell you that a fund should typically actively managed fund has to outperform the index, but that's not happened. Almost majority of the multi-cap and large cap funds, if you see today, they have been underperforming the indices since almost 2 to 3 years now. I would like to give you some perspective of this. There is a different perspective which you need to look at, because I guess investors are typically looking at only returns, but there have been certain regulatory changes, and even the markets have behaved in a very different way. And that's one of the reasons why you see most of the large cap funds and multi cap funds which have underperformed. Now, let me first throw some light upon these two aspects, I'm sure you would find it very helpful. Uh, First is, how has the markets behaved? If you see the way the markets have behaved in the last 3 months, 3 years, sorry, there has been a very narrow participation of equities. Only a handful of companies have risen, whereas most of the markets was sideways or even went down. Now, this is not very healthy for equity funds, which hold about 30 to 40 equities in their portfolios. Uh, some perform, but maximum have underperformed. Banking and finance constitutes 35% of the Nifty weightage. Now, the post-COVID lockdown, this sector has actually underperformed due to the expected write-downs due to the impact of COVID. Uh, the next reason is basically, mid and small caps have been underperforming since almost 4 years now. In fact, if you just leave aside these 6 months, there has been a huge underperformance from the mid and small cap space. Uh, Now, the next aspect is there has been a recategorization of schemes from SEBI, which happened in March 2019. Now, what is this recategorization? Schemes had to change names as per their objectives. They had to, the fund managers could only invest in a universe of stocks which was prescribed by SEBI. Now, this is not very healthy, as it actually becomes very rigid for a fund manager to invest in universe of stocks which is prescribed by SEBI. So, for example, a large cap fund which earlier could invest up to 200, their universe was up to 200 stocks by market cap. Now they can only invest in the top 100 shares which are again prescribed by SEBI. Now, this has led to fund managers dumping shares which did not fit in the SEBI criteria, and this has led to a huge underperformance. This lack of flexibility in this fund has led to an overall underperformance of actively managed large cap funds specifically. Recategorization is a big change in a way that the funds will be run going forward, and some categories like multi caps will become more risky due to increased allocation to the mid and small cap space, which is prescribed by SEBI. Uh, Investments, basically, the investors need to reorganize their holdings now by weeding out funds. So what typically now you will have to do is, do not go and redeem a fund just because they have underperformed. You need to keep certain things in mind. That recategorization has happened last year. It has led to some funds which are completely going to be, you can say, they will actually be impacted the most, and the impact is going to be permanent. Whereas a few funds, the impact is not going to be permanent, and once the recategorization and the fund managers has done changes to the to their allocation based on the SEBI prescribed norms, they would come back to normal. So, categories like large cap funds, uh, and if you ask me, this fund typically, this space, I don't expect them to outperform the indices in the future now, because of the rigidity which is there. So you need to look at low cost passive options like a normal index fund, which at least will give you an index return, and they will not underperform the index. One thing, do not rule out mutual funds, equity mutual funds, just because they have been underperforming. Recategorization has permanently impacted the capabilities of some funds. Uh, to outperform, some funds will see a dip in performance till the fund manager reorganize, but then things will come back to normal. This is what I wanted to highlight upon, that the way the investors are behaving, they are moving out of equity funds and getting into direct equity. I think you need to give some benefit of doubt to equity funds, and the fund managers all of a sudden have not become a bunch of underperformers, but the regulation has. It's just because of regulations that the underperformance has happened. Hope you like this video. Thanks a lot and be safe.